Hello, and welcome to Donutian Investment. This analysis is for EOG Resources on the New York Stock Exchange as of 7th of August, 2026, with a share price of $136. The full report is on donutian.ca. A short-term hold at $136.20. EOG is one of the best-run, cheapest oil producers in America. But the oil tailwind that drove the prior buy has faded and the tape has rolled over. Short term, this is a hold. Buy a confirmed bounce, don't chase the fall. Medium and long stay. Buy on the fundamentals. EOG is a low-cost Permian and Eagle Ford producer with one of the lowest break-evens in the peer group, around $45 to $50 a barrel, and a near debt-free fortress balance sheet with roughly 40 times interest coverage. The second quarter confirmed it. Record cash generation, production up 24%, earnings of $5.15 a share. On our scorecard, quality scores 82. This is genuinely a company you want to own. The debate is purely about the entry. With the oil amplifier gone, the medium and long buy rests on the fundamentals, and they are attractive. EOG trades on about 9.4 times forward earnings and 5.4 times enterprise value to cash flow, cheap for an E&P, with a free cash flow yield near 9%. Against a warranted 15 times multiple, it changes hands at roughly 10, a genuine discount. Analyst consensus sits at $163, close to 20% above today. That is why we hold medium and long conviction, even as the near-term signal steps aside. Here is why the short-term call is a hold, not a buy. The driver has faded from tailwind to neutral. Crude is down about 15% off the Iran shock peak, with West Texas around $77 spot, not the inflated oil fund level. The tape reflects it. The stock is below its 50-day line at 137. The daily momentum has weakened. The relative strength number is soft. Our discipline needs the tape to confirm before a fresh short-term buy. So we wait for a tested bounce off 127 to 132, or a reclaim of the 50-day on volume. The balance of risk is real and two-sided. EOG is a price taker. It has no moat against the commodity, and if crude keeps sliding toward the low 70s, this high-quality name falls with the sector. Our bear case is $110, about 19% below today, and we weight it at 26%, heavier than the 22% we give the bull. The falling tape can carry the stock into and through its support before it stabilizes. This is precisely why we hold rather than chase. The business is a buy, but stepping in front of a falling oil price is poor risk-reward. Now weigh the risk against the reward. The bull case is roughly 32% above today, the base case, the most likely, about 14%, and the bear case a fall of about 19%. So you are risking about 19 to make 32. So, our call on EOG Resources on the New York Stock Exchange, hold. Remember, this is for education, not financial advice. Always do your own research. This analysis is by Donutian Investment at donutian.ca. The link to the full report is in the notes below. Have a great day.